Everybody, and a big thanks to Matt and the team of Marine Money. Can you please welcome our panel, Tasos Aslidis, the Chief Financial Officer of Euroseas and EuroDry, Omar Nokta, Managing Director of Jefferies. Hi, Omar. Alexis Stephanou, the Chief Financial Officer of Goldenport Group of Companies. And of course, Achilleas, Tasioulas, Chief Financial Officer of GasLog Limited and GasLog Partners. Hello, guys, and great to be sitting here with you to have an interesting discussion on our panel. The world has been benefiting from a benign global trade environment for the last 25 to 30 years. Yet, the pandemic has shown us that maybe this is not necessarily a good assumption. We saw how vulnerable those links are to disruption. Globalization, supply chain disruption, inflation, a rising dollar, and of course the Russian invasion of Ukraine in February this year have all become themes, words that preoccupy us all on a daily basis as we try to go about our lives and our business. Omar, Russia's invasion of Ukraine constitutes the biggest threat to peace and security in Europe since the end of the Cold War. We have all been witnessing thousands of deaths, towns destroyed, and the world order being challenged. As the conflict continues, we could be heading to a global famine towards the end of the year. Jefferies took action and tried to help. Can you please tell us a little bit about that and what it means to your company?
Thank you, Nico. Can you hear me? Okay. Yeah, thanks, Nico, and thanks, Marine Money. I'm very, very happy to be working with a firm like Jefferies. You know, being in the U.S., sometimes when wars break out, it tends to, for Americans, a lot of times it ends up being out of sight, out of mind. We're so far away and far removed. But in this situation, it definitely feels very different. Everywhere we go, we see flags for Ukraine. We stand with the Ukraine. When I go into the office every day, I see a banner that says we stand with Ukraine. So it's definitely, this one is different where we're feeling it, and it's tragic, the loss of life and the atrocities that are happening. But why I'm lucky to work with Jefferies is immediately after the breakout of hostilities, Jefferies set up $1 million and said, okay, we are donating $1 million to Ukrainian relief, urged employees to participate, and we raised $700,000 from employees working with the company. And then we did a charity trading day where all of our commissions were 100% diverted towards the effort, where we raised $12 million for that. So very exciting to be a part of it and feel that we're doing what we can, but there's definitely a lot more to do.
That's excellent and so important in these days for all of us to look at the human side of things in our lives. Now, the global shipping sector rebounded strongly from the pandemic in the container and dry bulk shipping. A lack of capacity to handle the unexpectedly strong wave of demand and COVID-related closings disbalanced global supply chains and led to spiking tariffs. In the first few months of 2022, the situation started to improve, especially in clogged American ports. But the Russian invasion of Ukraine and the return of lockdowns in China has caused disruption. Tasos, Euroseas is operating a fleet of 18 vessels on the water, and the company has placed orders for 9 new building vessels to be delivered between 23 and 24. EuroDry controls 11 bulk carriers with a total deadweight of 800,000 tons. We are now 7 months into the conflict, and I'd like to ask you if to date the war and the ensuing inflation are having any material effect on the company's strategic plans.
Thank you, Nico, and let me take my turn to thank also Marine Money for the invitation and the organization of this, of the conference. I have to say that our strategy was really formed during 2021 and the beginning of this year, when we saw, as you mentioned, the significant rebound, especially in the container ship markets. That gave us the opportunity to build a charter book, unprecedented for a smaller container company, that allow us in turn to embark on a new building program to do a little bit towards decarbonization. Benefits with conventional technology is much better of the existing ones. and secondly, to carry the company into the next decade. That strategy really hasn't been affected up to this point with the developments in Russia and the war with Ukraine. Simply, we need to be a lot more diligent in this uncertain geopolitical environment with high inflation, with potential demand weakness, in implementing the strategy and being on the lookout for other reasons that could disturb it.
Okay, I understand. Thank you very much, Tasso. Now, Alexis, Goldenport controls a fleet of 18 bulk carriers on the water. You have 16 product tankers, 6 container ships, and also 5 new building bulk carriers in order for delivery 23 and 24. From your side also, a couple of comments as to how perhaps the war and the ensuing inflation has an effect on the company's business plan.
Many thanks, Nico, and again to Mia and the Marine Money team. Our strategy at Goldenport has remained focused on diversification. Shipping is a cyclical and volatile industry, so for us it is important to diversify across different segments and adjust, making the marginal investments in sectors that we feel are particularly interesting at that point in time, divest some vessels from sectors that we feel are becoming a little bit toppish. Clearly, geopolitical events are directly affecting shipping and in a magnifying way. So the war has clearly impacted the business primarily on the tanker side. I think Leon in the first panel explained how there has been a positive impact on ton miles and how this is actually going to be exacerbated, I think, when the exemptions stop in December for crude oil and in February for products. At the same time, the supply of tonnage is fixed. There's a very limited order book, so second-hand prices have increased quite dramatically. So we took the opportunity in this particular context to sell some of our older product tankers and focus more on the modern eco tonnage that we have acquired more recently, in recent years.
Okay, very good. Achilleas, GasLog now operates a fleet of 20 LNG vessels, and you have 4 new buildings on order. Several European countries are highly dependent on Russian natural gas supplies, and as we are all experiencing, they are rushing to reduce dependencies. The European Commission aims to replace a third of the Russian gas, sourcing 50 billion cubic meters. That's about 33% per year, by geographical diversification of LNG sourcing. In addition, the Russian LNG supply has now to be replaced. The shift from pipeline to sea will lead to an extra push for LNG shipping demand over the following years. There is an argument, however, that there might be some reluctance to invest in a 20-year term, as LNG isn't a sustainable low-carbon energy source in the long run. How would you comment on that? And could you give us a little bit of an insight from your side?
Thank you, and thank you for the opportunity to talk about the LNG. So the situation today, it's difficult. We have an energy crisis in Europe, and this is out of control, and Europe cannot really manage this. The Russian gas is not flowing in enough capacities, and this will deteriorate probably in the future, and there are analysts that believe that by the end of 2023, there will be no gas on the pipelines from Russia. So we are where we are today, and this is the result of many mistakes of the energy policy in Europe the last years. Now, specifically to your question, today we face an LNG supply issue. There is simply not enough LNG that creates all this mess. And this will be fixed by new FIDs, new projects on the LNG supply side. And in order this to happen, we need long-term contracts in order to find financing and take FIDs. Without long-term contracts on new LNG supply, there is no future. So I don't see the situation that you described on short-term issues on the LNG market. It is the transition fuel. There are no other solutions. Renewables are there, but not at scale and not available always. And net zero solutions simply don't exist today. They may come up, and they will come up, but at a cost and in the future. Today, Europe burns more coal, which is actually the exact opposite from what the plan was, which is scary when you look back and see what the plan was. So there is an issue that we need to solve, and this is the LNG prices. And for me, this is the biggest threat for LNG. Not the viability as a transition fuel, but the LNG prices.
Right. Thank you very much. Tasos, when the pandemic hit, businesses cut down on working hours, shut down completely. And in the US, we had about 22 million jobs that were lost, even temporarily. That meant that we had a significant decline in a yearly output. The result was obviously a severe recession. As demand started to come back, costs increased, and as a result of decrease in supplies and major raw material shortages, which together with savings rate contributed to inflation. The annual inflation rate as of the end of August 22 for the US is 8.3%, and that's the highest in 40 years. And for the Euro area, 9.1%. Interest rates are now going up. We're all experiencing that and we're seeing it. What does that mean for your company, and how are you responding to this trend?
We were expecting that after the reaction to the pandemic and the monetary easing that was induced to help the economies and the activity, to be some withdrawal of that, and consequently a bit higher interest rates. Demand shifted from services to more durable goods, and that created the increase in rates that you mentioned, and potentially created demand-driven inflation. That was meant to be dealt with through the central banks by the increase of interest rates. The subsequent war that ensued created supply-driven inflation, which is very difficult to be dealt by playing with interest rates. In any event, higher interest rates is a fact of life for us. There isn't much we can do in the near term other than try to hedge it to the extent possible, especially if you believe that they're going to keep growing. That also means that the cost of capital for the industry will go up. It's not only the interest rates, but eventually, due to the inflation and the greater risk around, equity will demand higher returns, and the total cost of capital will go up. So although in the near term there is little we can do and only deal with interest rates, in the medium and longer term, if we are to operate on a higher cost of capital environment, the whole strategic thinking about investing, about how you evaluate investments will have to be affected. At the same time, high inflation, in a high inflationary environment, having hard assets, steel, our ships, is a natural hedge. So it's an interesting environment that's evolving in front of us, and we have to get accustomed to dealing with a higher cost of capital across the board.
Right, thank you. Achilleas, any comment on that, on what Tasos just said, and perhaps something from your end?
Yes, can you hear me? My comment would be that taking as an example the LNG sector, it is a hot market, so we try to take advantage and manage our spot exposure, fix for longer, and then use these resources to de-risk our balance sheet. Especially at GasLog Partners, we direct all of our cash flows on deleveraging. This improves materially our break-evens. And we also buy back prefs that they are quite expensive. So we try to manage our capital structure. I think that the shipping companies, because of this cyclicality, should not lose sight and lose the advantage to de-risk the balance sheet at the right time. And this is what we do at GasLog in this period.
Right. I see that you're nodding on that, Alexis. Please, any comment from your side as well?
I would like to add that obviously the decision to hedge the interest rate risk is one that one needs to take when the rates are at the low point, rather than, I think now it is too late to be hedging this. So we actually we did hedge a part of our interest rate risk exposure approximately 2 years ago, and actually now we feel that the trajectory and the path of rates rising is obviously priced in the market. So we are actually in the process of closing our hedging positions at the moment because we believe that as the US and the Eurozone are heading into a recession, the more likely outcome from here is that the central banks perhaps do not increase rates as aggressively, or rates peak at slightly lower levels than what is currently priced in the market. So that is one part. The other part is obviously directing cash flow to debt repayment, so prepayments, because it doesn't make any sense to have the negative carry effect.
Understood. And Omar, please, your turn. And if you have any idea to share with us as to where interest rates are going, we would be happy to hear them.
It sounds like they might go higher for another 2 months. But no, I just wanted to follow up that, speaking from, say, the perspective of investors or Wall Street, there is actually nothing wrong with paying down debt. And I think you're being rewarded in today's market from investors who, clearly the uncertainty out there and the costs are rising, that taking excess cash flow and using it to go into the balance sheet versus paying it out as dividends or buybacks, I think there is a lot of positivity coming from investors looking for that. So as a management team, I wouldn't be too nervous about prepaying debt.
Very good. Thank you very much, Omar. And in fact, I'd like to continue on the point of what we're seeing as the effect of inflation and rising rates. And as the CPI increases and the Fed in the United States are raising interest rates, as we have already said, investors, and we have heard that from the previous panels as well, prefer to hold investments in hard assets. Now, ship prices in nominal terms are now in the highest level since 2009. We've heard that from John Cotzias as well earlier when he spoke. Further increases are likely in raw material, and energy prices continue to climb. Wherever we look, it is the fact that today's new building prices are very high. As an example, Clarksons reported that a 15,000 TEU container vessel, now costs more than 50% more than it did 15 months ago. Cape-size bulkers are up by almost a third, MR tankers by 21%, and LNG carriers by some 18%. And Barrogliano reported that, in fact, which is something that we're all seeing, container carrier orders surpassed bulker and tanker orders for the first time in history. On top of that, there were 86 large LNG carriers ordered in 2021, which is an all-time record. Most of the Chinese yards are now full for the next 3 years, and the situation is quite similar in South Korea. The ships of tomorrow, we all expect and believe that they're going to be costing a lot more, or more. Designed with engines that can adapt to a changing bunker backdrop, and also many vessels will be fitted with energy saving and other technologies, which is the arguments and discussions of the days. What would you recommend, Omar, that a ship owner does today at the end of the day? Order a new building, yes or no?
Wow. Okay. Good. Good question. I guess from my perspective, you mentioned the cost of a new building having gone up 50%. I forget what you mentioned, or a third. There are definitely been big price increases, but that's not necessarily the cost that's gone up. That's the selling price. And I think when we look at what shipyards have done, obviously in 2021, steel prices skyrocketed and new building prices followed. We have since that, we've seen steel prices come right back down, but the new building prices are still up here. And so there's a difference between what the steel cost input is and what the actual selling price is. It seems, obviously, with the order books being where they are and the backlogs for the shipyards being stretched out to 23, 24, and into 25, there's no real reason for the yards to lower prices. But it definitely seems, based off of the steel price correction we've seen, that you can expect new building prices to start to come down. And so, as a ship owner, I would say no rush, no need to order in today's heavy price environment. It feels within the next 6 months we should start to see some prices correcting. And then at that point, it may start to make sense to order ships.
Very good. Thank you, Omar. Tasso, does that mean that there is in the books more thoughts for placing orders?
We have completed this round of ordering. I think we try to match the expected cash flow that we have from the charters and to the order program, to the new building program that we have put in place. I think we are done for the time being, and we'll see how the market develops. Obviously, on the matter that you asked earlier about the potential movement of new building prices, I remember from my early days as an analyst, there are 3 broad factors that affect them: the steel price, the market itself, and the exchange rate to the dollar. I think the dollar is getting stronger, and that very likely might mean that new building prices expressed in dollars might come down, although they might still be high in the local currencies.
Right. And Alexis, looking at the diversified fleet that you have and what's in the books these days, what are the thoughts perhaps on new buildings from here onwards? What's your view on that?
Well, for us, especially on the dry bulk side, we have always invested in new tonnage. So all the vessels in our fleet are vessels that we actually built for our company. So again, for us, the focus area within dry bulk are the small, medium-sized vessels, so Handys and Ultramaxes currently. So what we are doing at the moment, we have a sort of an upgrade and a replacement program that is ongoing for some older Supramaxes that we have in the fleet to replace them with modern Eco Ultramaxes. So that is ongoing, but clearly also the technological change and the lack of clarity regarding the future of fuels and so on, I think that is generally discouraging the industry from proceeding with sizable orders, and clearly the prices as well, I think, are discouraging most participants from ordering new tonnage.
Right. And Achilleas, with your firm commitment to LNG and how you're looking at things, what's your view?
Well, it's complicated. We ordered all of our new buildings at below 200 million, and now prices are close to 250, if not more. The delivery period was 2.5 years maximum, and now it is 4 years. The shipyards installments were approximately 20% in most of the cases on the pre-delivery, and now it goes to 40%. And cost of debt, we covered that. So it's a difficult decision to take, to order a very expensive asset paying 50 to 60 million more that you will take delivery in 4 years with no EBITDA until then, with an expensive financing, with an unspecified useful economic life that used to be 35 years, and now this goes beyond 2050. So I would be skeptical.
Right. Okay. I understand. Thank you very much, Achilleas. Now, a big question has been debated heavily during the pandemic, that all the stuff that has been moved offshore can it now be moved onshore? It used to be that it was cheaper to produce something somewhere. If it was cheaper to produce something somewhere, then capital would go there, and that would, of course, consequently raise the standard of living there. Now, however, resources are being allocated based on political and ideological concerns or issues. Due to the worries of conflicts, wars, every country wants self-sufficiency. So is deglobalization the new norm? Is it the answer to current supply chain problems? Some people would argue that it's all about rerouting, diversification in suppliers and/or regions, more stockpiling and inventory building, and that it's not about the end of globalization. Right now, it's a matter of planning further ahead than ever before, creating new opportunities for trade, they argue. Would you agree, Omar?
Yeah, that's very interesting. I guess, I'm a shipping analyst, and I studied finance in college. I'm not an economist, don't have a PhD in that respect, but what I could at least say in terms of globalization, just learning from history, globalization has been a theme for hundreds of years. And it's the path to best returns, not necessarily riches, but just the best returns on capital is globalization. But anytime you have an economic shock, deglobalization takes effect. It happened after the stock market crash of 1929. It happened again after the Great Recession in 2008, 2009. Those typically, when you have these deglobalization efforts, it's political. You're also trying to feed your own country, and that typically lasts for 5 to 10 years. But what seems to have been very different this time around is as we proceeded through the last decade, whether it was Brexit or Make America Great Again, those types of themes really started to dominate. And then just as it seemed like maybe they were giving way towards globalization themes again, you've had the supply chain issue. And it does feel that it's unclear going forward if there's going to be a further deglobalization. What is obvious is if we look from 2000 to 2010, if we just think of it from the container perspective, GDP, if it grew 3 or 4%, container trade grew double that. But over the past 10 years, container trading has been in line with GDP. So that multiple is clearly diminished, and it's the deglobalization. Going forward, there has to be, and what you just talked about, there is a big, real diversification right now that's happening in terms of finding supplies. And it's not just going from China to the U.S. Now, U.S. importers are looking for various suppliers. So I think there's a diversification, which I think generally should be more globalization from here.
Tasos, would love to hear your view.
I fully agree with Omar's observations. I think the benefits of free trade are enormous, and that has proven itself throughout history. If you look in the years in the BC years, more recently, so it is the answer to the geopolitical worries and the supply chain issues is not, I believe, reversal of globalization, but perhaps a redefinition or some introduction of some parameters along which you should take into account to optimize trade. So if you taste free trade and the benefits of it, it's hard to give them up.
Understood.
Can I make
Now,
a comment?
please.
In a positive tone. So you described very well the situation. It's all summarized in one word, inefficiency. And inefficiency works quite well for shipping. So this is the positive tone.
Point well taken. I know we're running out of time, guys, but there is one last question that I'd like to ask each one of you. In one word, if the audience here were to say, look, we're going into Q4 22, and as we look forward, we'd like to hear maybe one piece of advice from each one of you as to what we are to do going forward. Omar, we'll start with you.
Very quickly, I would say, don't be afraid to sell an older ship and take advantage of the active S&P market and take the proceeds and invest in a more newer ship. We're seeing companies in the public markets get better valuations the younger the fleets are.
Alexis, it's yours.
Well, I would say charter coverage, but then, for container ships, it's probably too late. For the tanker owners, I think they will be tempted to keep trading short term because of the disruption in the market. For dry bulk, again, probably people will maintain a mixed approach to employment because I think everyone is hoping that things are going to change in China in the coming weeks with the Communist Party Congress.
Achilleas?
Well, new buildings are delivered on time. Projects, they are not. So be careful with the new building ordering because you know, we have seen the movie of misbalance on supply-demand of vessels.
Right, and Tasos?
I was very lucky early in my business life to learn one thing, that cash is king. And as we move into a period of geopolitical uncertainties and high inflation and potential low demand, I think being liquid enough is going to be the ticket out of a potential new recession. And John Koustas earlier confirmed just that. Having cash flow lets you weather all storms.
Thank you. So I'd like to thank all four of you. And as a last comment from my side, if I may, I'd like to go back to how we started. And let's all join wishing that the conflict that we're experiencing, the war that's taking over now, comes to an end soon, and we all start living again like human beings. Thank you all.